Picture this. It's a quiet Tuesday morning on the Central Coast. Barry, 72, and his wife, Margaret, 70, are sitting at the kitchen table with a cup of tea going cold beside them. They've just signed the contracts. Their family home of 31 years sold for $1.2 million. The kids are grown, the garden was getting too much, and they've found a lovely little unit in a retirement-friendly complex down the road for $800,000. Smart move, practical move. They're feeling proud. Then the letter arrives from Centrelink. Their combined pension, $1,725.20 per fortnight, has dropped significantly, and they have no idea why, because no one told them about the deeming trap. No one warned them that the moment that settlement money hit their bank account, Centrelink started counting it as income, even though it was sitting there waiting to buy their next home. And here's the part that stops most people cold. With the deeming rate freeze scheduled to end on the 30th of June 2025, anyone selling their home in 2026 is walking into a much sharper version of exactly this trap. Stay with me today, because by the time we're done, you will know exactly how this works, exactly what it costs if you get it wrong, and exactly what to do to protect your pension before, during, and after a home sale. This information could save you thousands of dollars a year. G'day Australia, I'm James Walker, and welcome back to Aussie Pension Watch, Australia's independent guide to getting every dollar of pension you've rightfully earned. Now, if you're thinking about selling your home, downsizing, moving closer to family, or someone who is, this is one of the most important videos I've made this year. We're going to walk through the real rules, the real numbers, and the traps that even experienced homeowners fall into. No jargon, no panic, just straight answers. I've spent years helping Australians navigate the Centrelink maze, and I want to make sure what happened to Barry and Margaret doesn't happen to you. If this channel has been helpful for you or someone you care about, do me a small favor right now. Hit that subscribe button and tap the little bell icon beside it. Every single week, I put out plain English updates on pension rates, Centrelink rule changes, and practical guidance specifically for Australian seniors. It costs you nothing, and it means you won't miss something important when the rules shift. Good on you for being here. Now, here's the bigger picture, and why this matters so much right now in 2026. According to the Australian Housing and Urban Research Institute, roughly 1 in 5 Australian retirees seriously consider downsizing at some point. But pension anxiety, the fear of what it'll do to their Centrelink payments, is consistently the #1 reason people hold back. They stay in homes that are too big, too expensive to maintain, and too hard on their bodies because they're frightened of making a mistake they can't undo. And that fear is not irrational. The rules genuinely are complex. But here's the thing, complexity doesn't have to mean confusion. What I'm going to give you today is clarity. According to Services Australia, the maximum age pension as of the 20th of March 2025 sits at $1,144.40 per fortnight for a single person, and $1,725.20 per fortnight for a couple combined. Those figures will be indexed again in September 2025 and then March 2026, in line with CPI movements. We're talking about a significant income stream. And when you sell your home, that income stream is immediately at risk if you don't understand how the system works. Let me break this down properly. Now, here's the first thing I want you to understand. And please, pay attention to this part, because most people get it completely backwards. When you sell your principal home, the home you live in, and you intend to buy or build a new one, the sale proceeds you plan to reinvest are exempt from the assets test for up to 24 months. That's the rule that was strengthened under legislation, effective from the 1st of January 2025. 24 months. That sounds incredibly generous, and in one sense, it is. But here's what most people completely miss, and this is where Barry and Margaret's story falls apart. The exemption only covers the assets test. It does nothing, absolutely nothing for the income test. The moment that settlement money lands in your bank account or in any financial institution, Centrelink deems it to be earning income. That's what deeming means. Centrelink doesn't care what interest rate your bank is actually paying you. They apply their own rates and say, we're going to assume this money is earning a return, and we're going to reduce your pension accordingly. Right now, according to Services Australia, the lower deeming rate is 0.25% on the first $62,600 for singles, or the first $103,800 for couples. Anything above those thresholds is deemed at the upper rate of 2.25%, and that upper rate applies to everything over the threshold, including every dollar of your home sale sitting in the bank waiting for settlement on your new place. Let me put real numbers on that for Barry and Margaret. They sold for $1.2 million. They plan to spend $800,000 on the new unit. Under the rules, the $800,000 they intend to reinvest is asset exempt for 24 months. But the income test doesn't care. The entire sum, all $1.2 million, is deemed from day one. On the amount above $103,800 for couples, that's deemed at 2.25%. We're talking roughly $24,000 of deemed annual income. That can easily wipe out entitlement to a partial pension entirely or reduce it by hundreds of dollars per fortnight, depending on your other assets and income. Now here's where the 2026 situation becomes particularly serious. The current deeming rates, 0.25% and 2.25%, have been frozen by the federal government. That freeze was extended to the 30th of June, 2026. After that date, rates are expected to rise. No one can tell you exactly how far or exactly when, but the direction of travel is clear. Anyone selling their home in the second half of 2026 or searching for their next home during that period is likely facing a higher deeming rate on those sale proceeds than the people who sold a year earlier. That's the 2026 deeming cliff. It's real, and most people haven't heard of it yet. Here's the second thing I want to walk you through, and this one trips up even financially savvy retirees. When you sell your home and you're waiting between properties, Centrelink classifies you as a temporary non-homeowner. Now, in one way, that actually helps you. The assets test threshold for homeowners and non-homeowners differs by $252,000 as of the 1st of July 2024. So becoming a temporary non-homeowner raises the asset limit you can hold before your pension is affected. That's a real benefit. And this is a meaningful, but in most cases, the full value of a modern Australian home sale far exceeds that $252,000 difference. So while the higher threshold offers some buffer, it rarely covers the full exposure. You're still going to feel the income test impact through deeming, even if your assets temporarily clear the bar. Take someone like Helen, 68, from Ballarat. She's single, sold her home for $650,000, and plans to spend $550,000 on a smaller place, closer to her daughter. She's done the asset maths and feels okay. But no one has shown her the income test calculation. On $550,000 of deemed proceeds, after the exempt threshold for a single bars, she could be looking at more than $10,000 of deemed income per year. Depending on any other income she has, that could reduce her pension by over $200 a fortnight. That's more than $5,000 a year she wasn't expecting to lose. I know the paperwork side of all this can feel overwhelming. You're not alone in that. But the calculation side is actually manageable once someone explains it plainly. Now pay attention to this part, because it's one of the most misunderstood rules in the entire system. The 24-month asset exemption only applies to the portion of the sale proceeds you intend to use for the new home, not the total sale price. If you sell for $1 million and only plan to spend $700,000 on a new place, the remaining $300,000 is assessed as an asset from day one, and it's deemed as income from day one. It doesn't get the benefit of the exemption just because it came from a home sale. This matters enormously for people who are genuinely downsizing and will have leftover cash. That surplus needs its own plan. And one of the most powerful options for those who qualify is the Downsizer superannuation contribution. If you're 55 or older, you can contribute up to $300,000 each. So up to $600,000 for a couple dollars into your superannuation from the proceeds of selling your home. You don't need to meet any work test to do this. According to the ATO, this is a legitimate and legal strategy confirmed under current legislation. Now, I want to be very clear here. Money in super is still an accessible asset for age pension purposes, so it doesn't disappear from Centrelink's view. But it can still be useful from a broader financial planning perspective, and it's worth understanding as an option. Speak with a financial information service officer about how this might apply to your situation. If you're finding this helpful, I genuinely appreciate it if you dropped a quick comment below, even if it's just the word helpful or thank you. It sounds simple, but it matters. That activity tells YouTube's system that this information is reaching people who need it, and it helps the channel show up for other Australian seniors searching for the same answers. So please, take 5 seconds and leave a word below. Let me also flag the gifting trap, because I see this one cause real heartache for families. After a home sale, some retirees want to share a bit with their children, completely understandable. But Centrelink has strict gifting rules. You can give away up to $10,000 in any financial year, and no more than $30,000 over any rolling 5-year period, without it affecting your pension. Give more than that, even if it's genuinely a gift and the money is gone, and Centrelink still counts it as your asset for 5 years. They call it a deprived asset. It's one of the harshest rules in the system, and it catches people who are simply being generous with their family. The third trap I want to mention is rent assistance. If you sell your home and move in temporarily with your adult children while you search for your next place, which many people do, and it's completely reasonable, you won't qualify for rent assistance during that period because you're not paying rent. Rent assistance can be worth up to $184.80 per fortnight. That's a meaningful amount to lose, even temporarily. Factor it into your planning. Right then, here's exactly what I want you to do this week, if any of this applies to your situation or someone you care about. First, before you sign anything or even seriously engage with a real estate agent, log in to your MyGov account at my.gov.au and check your current age pension details. Know what rate you're on, whether you're assessed under the assets test or income test, and what your current asset and income figures look like. You cannot plan a move if you don't know your starting point. Second, call Services Australia on 132300. That's the older Australians line, open Monday to Friday, 8 in the morning until 5 in the afternoon. When they answer, ask specifically to speak with a financial information service officer. This is a completely free service. The FIS officer can model the impact of a home sale on your pension before you commit to anything. Most people don't even know this service exists. It could save you from a very costly surprise. Third, if you do sell, you must notify Services Australia within 14 days of settlement. This is a legal obligation. Missing that window can result in an overpayment, which means Centrelink will want money back. Use Form SS484. That's the form to report a change of address and circumstances. And make sure you clearly state your intention to purchase a new home. This is what triggers the 24-month asset exemption. Without that declaration, you may not receive it. Fourth, review your plans for any leftover proceeds. If your new home will cost less than your sale price, Plan what happens to the difference before settlement day, not after. Understand the gifting limits. Understand your deeming exposure. And if you're 55 or older, ask the FIS officer about whether a Downsizer super contribution makes sense in your specific circumstances. Fifth, put a reminder in your calendar for the 30th of June 2026. That is when the current deeming rate freeze is scheduled to end. If you're still between homes at that point, still holding sale proceeds, your deemed income calculation may change. You need to know about it so you can respond, not be caught off guard by a letter you didn't see coming. Now, of course, every situation is different, and what I share here is general information, not personal financial advice. For your specific circumstances, always speak with a financial information service officer at Centrelink. It's a free service, it's confidential, and it's staffed by people who genuinely understand these rules. You can reach them by calling 132300 and simply saying the words Financial Information Service when prompted. Here's something I want to say from the heart, and I want you to hear it clearly. You worked your whole life for this country. You paid your taxes in Toowoomba and Newcastle and Geelong and Perth. You raised families, you built businesses, you showed up every day for decades. The age pension is not charity. It is not a handout. It is a system that you contributed to and that you have every right to access in full. Don't let the complexity of the rules make you feel like you're doing something wrong by claiming what belongs to you. And don't let the fear of getting it wrong stop you from making decisions that could genuinely improve your quality of life. That's why I'm here. That's why this channel exists, to make sure you have the information you need to make your move with confidence. If today's video helped you understand something you didn't before, please give it a thumbs up. It takes 1 second, and it helps more Australians find this channel. Subscribe if you haven't already, tap the bell so you don't miss the next update, and share this one with a friend or family member who's thinking about downsizing. You might genuinely save them thousands of dollars. Next week, I'm going to walk through exactly how the pension loan scheme works in 2026, including the recent changes that make it more flexible than most people realize. If you or someone you know owns a home but is struggling with cash flow in retirement, that video is going to be essential watching. Don't miss it. This is James Walker from Aussie Pension Watch. You've earned this, Australia. Take good care of yourselves, and I'll see you in the next one.